Welcome to Property Developers Question Time, the conversation. Today I'm joined by Nicholas Wallwork, CEO of Property Forum. Nicholas has just released a book called Investing in International Real Estate for Dummies, and Rod Turner, owner of ITP Group. Today we're going to be talking about state of the UK property market. And my first question today is to you, Rod. What are the main factors and trends that you see currently affecting the UK property market, inside and outside London?
I think there's quite a few factors, and you've almost got to break that question down. So if you're looking at the property market, we know it's based on three main things. One is credit, or the availability of money. Two is supply and demand, and three is sentiment. So if you go into detail maybe on each of those, we've got what would the availability of money be influenced by? And there could be things like government interventions. So some recent things in the past few years have been Help to Buy, have been increased mortgage terms. So first-time buyers can now get 40-year mortgage terms. Also, we've got affordability tests for mortgages. So those could influence that. Also, obviously, interest rates is a massive one there. And then if we kind of skip that section and go on to supply and demand, there's many issues from a development point of view with planning and some certain amount of red tape there. And then sentiment, we've got other things happening such as Brexit that can always pull it down. So, I mean, I suppose we can pick any of those points and probably go into a little bit of detail on them.
Sure, but the way I see things, there's a bit of a divide between what's happening in London, what's happened in London in the last few years, what's happening in London now, and what's happening outside London. So I know that you have been historically quite focused in London, but you've also recently done some bits and pieces outside London, and Manchester particularly.
Yeah.
So what do you see as being the difference in the way that the market is working in those sort of locations?
I'll explain to you the reasons why I stopped buying in London at the time that I did, which was actually when the stamp duty changes came into force, which I think off the top of my head was April 2015. At that point in London, that meant buying or trading in property over a certain level of value, you were going to get hit hard, and it meant people needed to come up with much higher amounts of capital for their deposits and stamp duty. That terrified me a little bit, because I was looking at affordabilities in London based on two things. One would be the upfront affordability. So that's things like the deposit, legal fees, stamp duty. And the second part of affordability is your monthly expenditure on your mortgage in relation to your salary. So a stat for the last sort of 30, 40 years is before every single property crash, actually that second metric, so the mortgage as a percentage of your salary, has always peaked above 60% in London. And I think at that time, in around 2015, it was getting up close to that level. It was about mid-50s, almost late 50s. And for me, that kind of set alarm bells going, and I wasn't confident in the London market at that time. So the reason why I chose Manchester was I was looking for where job growth and the average job wage was going to start to increase quite quickly. And the way I look through that is looking at investment into the infrastructure there. So investment into new business. So one of the big reasons was Salford Quays and Media City, which was creating 10,000 new jobs. We were having BBC, ITV move up there. And it's actually where we are right now. It's very similar, but instead of a financial area or hub, it's a media hub. So I quite like that, and I was looking at the affordability metrics there.
I think London's a bit of a micro market in itself, though, isn't it? And I think, it's a sensible thing to invest in any market where there's infrastructure, where there's inward investment from the government and something pushing that in any area. That's also happening in London, of course. There's lots of development, but that doesn't mean that London should be invested in, because I think, as you say, affordability is very high. You've got foreign investment that drives a lot of the London real estate market, and they're buying for capital growth. They're buying to sit on something for 50 years in a family fund. And your buy-to-let investor, as a smaller property investor, they can't sit for that amount of time. You've got to be, I think, very cash rich to buy in London. Yields are so tight, aren't they?
I think you hit on a really key point there, which was when you talked about foreign investors and what they were investing for, and it's very well. The decision you make on investment should be based on your aspirations for the future. So, if you're investing on that long term for 40, 50 years, versus if you're investing to get a yield or a pension pot or income, it's gonna, yeah, absolutely. It's going to be incredibly different on what you choose, and also, like you said, with the micro factors such as Crossrail in London's a big one, things like that. You've got Silver City over in East London coming up, so there's some really, really interesting things there. And London, but also London, people look at London and try and kind of judge it against other UK cities like Manchester, like Birmingham, things like that. Yeah. But also, London's a global city, so it's much easier to actually look at London in comparison with somewhere like New York, Sydney, Hong Kong, rather than these other regional cities. But
yeah, it's a different model, different strategies. If you want to go into London, there's a strategy to be had there. But as I say, it's high yields, high risk. I think let's talk about risk for a moment. London represents high risk. It's always the first to boom. It's always the first to bust in any market cycle, because it's so, it's so different to the rest of the UK. The rest of the UK tends to follow, lagging behind a little bit.
Actually, that's interesting, because to me, London is not really just one city. It's a bunch of micro cities. So what happens in Croydon is quite different to what happens in Kensington. And what happens in Kensington is quite different to what might happen in Stratford.
Being quite generalistic there.
Well, exactly.
Sorry.
But no. But I think that's an interesting point. I think there's also, for me, a very interesting macro trend, which I saw in the last property cycle. So before the global financial crisis, it seems to repeat itself, despite the fact that there are lots of factors that affect the property market, which is that London booms. London hits a peak and it has a couple of years of wobble or maybe decline. The rest of the country booms, and then London comes back again. So it seems like that is a sort of a trend which seems to happen in every property cycle.
I think like we were touching on with these sort of micro areas, you're going to have different factors that affect it. So, for example, you might look at Aberdeen and the oil situation and what effects that has on property. You might look at Swindon and was it the Honda factory? I can't remember which car factory it was, which actually, as a proportion of the jobs there, was very high. So it's dependent. And then you've got SA, so service accommodation in Margate, and the effect that has on the hotel. So it's not just the market; it's also where your product sits on that market. I think is quite key.
But I think service accommodation has been a very strong trend in a very general sense. So, I mean, and we've seen, on top of the rise of serviced accommodation, we've seen the rise of apart hotels as a different sort of a hotel format to hotels. And I guess in the same way, we've also seen the emergence of HMOs at the lower end of the market, which is translated into co-living on a larger scale. So we're sort of seeing those small trends being replicated as in large formats in different parts of the market. Those things.
Another sort of play on co-living,
exactly. Or it's a big version of buy-to-let, isn't it, in a way?
Ultimately,
I think it's what those people are doing quite well is looking at what this up-and-coming generation that's going to be the next one spending more of their money out there, and what the key thing that they're looking for is convenience. And I think that's a massive factor in a lot of these sort of co-living communities where absolutely everything is paid for. And you look at some of the other countries where it's kind of been spearheaded and how well it's worked. And I think HMOs have been around for forever. Shared accommodation's always been there, but it's often it's been seen as a lower value type of accommodation.
Yeah, it had a bad name, HMOs. I think before people got used to it, it was students and housing benefit type tenants, which are great tenants, but it takes a certain type of model. And
I think now actually there's a higher value model coming into play, which seems to be working really well, and it seems to be that some of these people want that. They want that flexibility of living there.
Well, I think in the way a precursor to it was the professional house share. So where in London or in Birmingham or Manchester, professionals might share a house. On a small scale.
Renting out my spare room.
That's exactly what I did. I bought a house in Hammersmith, rented out the other rooms. Probably a lot of us did. I know Simon Zucci got started the same way. A number of people I know got started in property that way. It's an interesting evolution of that trend. So one of the major events it's not a secret to anyone, I don't think, that's had an impact on the UK economy in some way or other is Brexit.
I haven't noticed that.
Yes. So, what impact do you think, Nicholas, that Brexit has had on the UK property market, if any?
Yeah, I mean, it's clearly had an effect. I think it's forming part of this market cycle. I think uncertainty breeds lack of action in a lot of ways. A lot of the mass market tend to be scared off by major market events like this. I think in the words of Richard Branson and Warren Buffett and the rest of the top entrepreneurs in the world, it's do the opposite of what the masses do. I see the opportunity in let's call it a stagnant and ever so slightly declined market in the last year or two due to the effects of Brexit. I think that's just that uncertainty. People are saying, foreign investors are saying, let's just wait and see what happens. Let's wait till it sort of hits the bottom. Let's all, everyone wants to hit the bottom, don't they? I personally don't care where the bottom is because I'm holding long term. Yeah. So for me, it's a buyer's market at the moment, a little bit, not radically.
Do you think Brexit is what's driven international investors out of the UK property market, or do you think it's something else? Do you think it's tax changes? Or do you think it's a combination of both?
Tax changes are affecting foreign investment. I think foreign investment is largely located in London. Obviously, there's lots of other areas. They like, student investments, stuff they can understand easily.
And if you look at sort of those tax changes, actually, if you compare it with a lot of other cities, even things like the foreign stamp duty is still not as bad as the majority of other cities. So the UK is still a useful investment from those point of terms. And
the weak pound, I don't think has done us any harm, but nonetheless, it's certainly the case that the market for foreign investors has fallen off significantly.
Well, I don't know if it has. I think it may have in London, but if you start looking at places like Manchester, Birmingham, Liverpool, the amount of foreign investment over the past 3 years has been colossal.
So you're saying people have just shifted their horizons. They're saying, okay, we don't see the opportunities we saw in the London market, so actually we're looking at regional cities now.
Absolutely.
Okay. I think that the regional cities have always had foreign investment, and they've basically retained a similar percentage of foreign investment. And I think it's a different kind of investor. I think the northern cities have a cheaper buyer with a couple of $100,000 to spend. They want a couple of flats. London is driven by the bigger players, the funds, the family offices, serious people that buy streets in Knightsbridge, and that drives London prices significantly up. That part's dropped off. So I think it's a different buyer, a different foreign buyer. We've got to look, if we're going to analyse the foreign buyers, it's a different market again, a different kind of purchaser that has a different capital amount to spend.
But that's interesting because it's certainly the case that only certain cities outside London attract foreign investment. I know, for example, you don't ever see foreign investors in Gloucester or Cheltenham, so we're doing a couple of developments out that way, and all of our buyers would be owner-occupiers. Would be very, and if we do see an investment buy, then it's a local investor, certainly not a foreign one.
Definitely.
So
I think that's just marketing, isn't it? I think if you live in Hong Kong as a Hong Kong national, you don't know about Gloucester. How would you have heard of that? There's not enough people shouting about it. Liverpool, Leeds, Manchester, Birmingham. You've probably heard of them.
Do you think that's all it is, or do you actually think that there needs to be the volume of transactions there in an active enough market to actually pull those investors in?
If that happens, then it'll get on people's radars. Exactly. Yeah. People will start selling it because it's doing really well, and people will start seeing it overseas. Yeah. How many cities in pick a country? How many cities in Australia do I know? Your sister country to New Zealand. I could probably name like 3 or 4 cities. Geography's not my strong point.
It's sort of next door, but it's about 4 hours away, just to be clear.
No, I do know that, sorry.
Don't want to be too closely associated with
Australians.
The
Australians.
Yeah.
It's like us and Welsh, we have a love-hate relationship.
Indeed,
when it comes to rugby, anyway.
Guys, thanks for your comments. We're going to take a quick break now, and we'll be back shortly with part 2. Welcome back to Property Developers Question Time, the conversation. I'm going to lead in with a question to you, Nicholas. What do you think the impact of a no-deal Brexit will be on the UK property market?
Well, who knows, I guess, is the honest answer to that. But I think uncertainties caused a certain amount of lack of action in the property market, in a lot of markets. I think people are trying to work out what will happen. I think people are quite afraid of a no-deal Brexit.
Do you think that's justified?
I think it's not 100%. No, I think it's far worse a deal than getting a deal. You know, without a doubt. We revert to World Trade Organization rules, but we have a I'm not going to call it a backstop because that's the wrong kind of backstop, but it is another
fallback position.
A fallback position.
Okay.
In the situation, which is depending on what sort of area of trade or whatever you're looking at, is going to be better or worse. Because some of the trade rules we have now are equivalent anyway.
But undoubtedly this is going to prove to be something of a shock to existing trading relations, because people aren't going to know how things are going to work from one day to the next.
Yeah, absolutely. Yeah. And I think the government's trying to do what it can to give good advice. I mean, there's some good links on the government websites as to what to do, certain VAT situations, certain tax situations, certain exports, problems that may or may not arise, this kind of stuff. So they are putting out a fair bit of information. I'd direct anyone to the government websites actually to see how it may affect your business. I think the property business is really affected more by the market sentiment. It's probably largely what's going to hit us, and uncertainty tends to breed lack of action, lack of activity, which I guess in turn maybe causes a little bit less demand short term for property. It's a great market to be buying in. You know, every market has an opportunity, whether it's up or down. And at the moment, I don't think we're flying downwards. It's just a little bit subdued. You know, prices dropped off the top a little bit. But I think as soon as it sorts itself out, we'll be back into some strong market activity, which will push prices.
I think I tend to agree, and I think once we get certainty about what will happen, the market, I believe the market will push up again, whether that's a no-deal Brexit or whether it's a deal. But I think we'll do better if it is a deal, probably. And certainly, you know, we have seen the availability of sites in London that would have sold very quickly a couple of years ago, and we've bought sites in London as a result of that. And I think those opportunities wouldn't have been open to us if there wasn't the level of market uncertainty that there was. I mean, Rod, you're doing quite a bit of stuff in London. Have you seen stuff that you would link to this Brexit-related uncertainty? Or
it's difficult to tell what it's linked to in particular, but I think it highlights the point on timing when buying. Even when people say they're buying for long term, so they're not too worried about how the market goes, that's all well and good as long as you're buying with cash. If you're leveraged and you suddenly need to refinance, and maybe the rental stress tests have changed and you can't refinance at 70% loan to value, you can only do it at 45, how are you going to plug that equity gap? And what I'm finding at the moment in London is lots of sites coming back on the market, whether that's vendors becoming maybe more realistic in their pricing to what the current market's doing, or whether it's people that maybe bought that site, took on some debt, and unfortunately couldn't get the end values that they were hoping for, and at the same time have then tried to refinance and found that actually they can't refinance at that high level to pay off their senior debt. So I think obviously there's going to be some casualties when the market goes down, but also there's massive opportunities there to come in and pick up those pieces as long as you're careful.
Yeah,
absolutely.
I mean, absolutely. Well, but I think there is a lot of cash around at the moment. There's a lot of money around at the moment, and I think what's interesting about this, you know, this little wobble that we've had in the market, there's certainly been a decline, a decline in the number of transactions. What it doesn't seem to have resulted in is a large number of distressed sales. So it doesn't feel like there's been a crash. It feels like the market's just slowed down. And so what people seem to be doing is just sitting on their hands and waiting.
I think that's interesting because actually in 2008 in London there weren't a huge amount of distressed sales either. However, if you go to other regional cities, there were a lot. And part of the reason for that could be the amount of equity that's at stake to be lost. And also people's financial positions, obviously. So if you're losing maybe, I don't know, 10% of a deal, of 10 grand, it's a lot worse than losing 10% of £1 million. So,
But I think in a way what you're saying though is owners in the London market are generally more equity rich.
Yeah.
That's effectively what you're saying. So they've got more of a buffer when the market moves.
well, that's due to the growth before the crash, because normally it goes up like that. So they've boosted that equity.
Well, don't forget, the finance got a lot tighter after the last credit crunch. So people have been lending more responsibly, and banks have been lending more responsibly. So there is more of an equity buffer.
Which is a fantastic thing.
Yeah, people that own properties and investors are better checked for their affordability and what they have in the background, not just their properties. So,
I mean, you're pretty good with market stats. Would you therefore say that people are more highly leveraged outside London in general?
They could be as a percentage of what the property value is, but often the yields are better. So it's actually the servicing costs of the debt are a lot better. It's all about the rental stress test and how they can service that debt that the lenders are keen on.
And I suppose there's a natural conclusion that there's going to be more of an equity buffer in a market that's risen more.
Of course,
So,
yeah.
Okay. So if the government managed to agree a Brexit deal, what do you think the effect of that's going to be?
it's going to be hugely positive. I think we all can't wait for that to happen. So every delay is just frustrating the public. It's causing uncertainty, and people just want to get on and do business. You know, we don't, as property investors and developers, I don't think any savvy or ethical developer or investor wants a booming market. We want a stable, solid market. You know, rising with inflation, of course, a little bit more, great. But we can make our money by adding value, and that's what investment is. And over the long term, inflationary increases, whilst you're paying off your debt, will build your equity and your pensions. And as a developer, adding value now and building something, you're building in your profit margin by adding value and creating something new. So actually, a nice, sensible market where there's a known exit, which de-risks any sort of investment or deal, is where I would like to see the market. And I think that will return after Brexit.
Yeah, I totally agree.
Yeah. Well, I tend to agree with you as well. I think we're going to see it return one way or another after Brexit. But if we get a deal, then and we leave in an orderly fashion and we maintain to the degree that we can a good relationship with the EU, then I think we're going to see more of a bounce in the property market. And again, I agree with you. I think there are lots of buying opportunities out there. So you guys are both property developers. And so I guess I'm interested in understanding where you see the opportunities today in the UK property market. What would you be buying and where would you be buying it?
Yeah, well...
And what would you be doing with it?
I suppose it depends. Every property's, you've got multiple exits. Well, you want to have multiple exits. So it's looking at everything from a reward versus risk and effort point of view. The more risk or the more effort, I want to be seeing a bigger chunk of reward. So at the moment, the way the market is, certainly in places like London, I'm still fairly hesitant because whether there's a deal that's going to be done on Brexit, I don't know the timeframes involved in that. And so I'm looking at investments where there's a cash flow from day one, but also there's a big value add somewhere. So it could be that you buy a commercial premises which has an existing tenant for maybe with a lease of running out in 5 years' time, and you know that actually there's quite a juicy permitted development right that you can apply to that once that tenant leaves. So things like that I quite like at the moment.
Yeah. Okay. So that's a strategy I've employed in the past, and I like that, where you can buy an asset that's got cash flow out of it. And you've got the time to deal with the planning process, which, as we know, is also slow. Thoughts from you, Nicholas?
Yeah, I mean, I think there's lots of emerging strategies out there, and I say emerging, they've been around a few years. We've all heard of HMOs, that's almost a mainstream strategy now. We've got serviced accommodation. We do actually build PRS and serviced accommodation buildings. So one building we've done in Newbury and Berkshire at the moment has got a mix of residential use and a bit of serviced use. And that's quite an interesting model. So there are these sort of hybrid models developing, depending on how easy and capable you are of managing a higher serviced model. As you say, there's a higher return for that kind of model, provided you get all your ducks in a row with planning and the
which
right
is a
spec and the
fantastic
build and the
thing
management.
as well.
There's more money to be made in these kind of what were niche strategies, but they're coming more mainstream.
Yeah.
With the, the advent of Airbnb and places like that, opening up shorter term lets to people. They're not as straightforward as everyone makes out, I might add. They're extremely complex, and planning, to say the least, is probably one of the biggest challenge areas. But if you can get all those things right, I think, operating in your micro market of a particular town, how much service versus how much residential you can blend is really, really an interesting mix. And if one starts to drop off, you can move to the other. So I quite like hybrid models, actually.
That's very interesting, because although those opportunities are primarily driven by a residential or residential-like use class, effectively by doing them on a large scale, turning it into a PRS scheme, then in a way what you're delivering is a scheme that's commercial in nature. And I think that's one of the ways that we've looked at mitigating the risk in the opportunities that we're looking at. So we're looking at schemes that have a residential opportunity, but where perhaps there's also an opportunity to end up with a commercial use. And I think what's interesting is that the UK economy has done, despite this uncertainty around Brexit, reasonably well. And so our view is that commercial market is somewhat insulated from the ups and downs of the residential property market. I think the other thing that's interesting, if you're looking at serviced accommodation or rental type models, is that if the sales of residential properties drop off, what tends to happen is that demand for rentals goes up, because people still have somewhere to live, need somewhere to live, and so it's a good way of insulating your
it's to totally
against those.
Back that point up. It's a case of the recent tax changes and things like that. I think the government are pushing the buy-to-let market into the hands of professional investors.
It works on a large
PRS
scale
stuff.
now, but not so much on a small scale. Yeah.
Which is probably good for the market, isn't it? I mean, better quality accommodation. We can cope with the regulation as slightly bigger players, and the end tenant should get a better deal.
Well, absolutely. You're creating a better value proposition for that customer, aren't you?
Yeah.
And I think that's only a good thing.
Yeah.
Yeah, indeed. Well, thank you very much, guys. Really interesting conversation, and looking forward to joining both of you on the next episode of Property Developers Question Time.
Thanks.
Cheers.